We are very much interested today on the economic development and in 2024. This is the topic of our webinar today, Outlook of China's Economy 2024. Before I introduced our two distinguished speakers, let me say some notes shortly before. I think most of you know that the growth rate last year, at least the official one, was 5.2%. Is this high? Is this low? It's not too bad. On the other side, the markets have been, the capital markets, more or less disappointed about that. We almost a crash after the figure was published. For whatever reason, we can discuss this later, and maybe our speakers have something to say to that. Also, we have also to see that the base, the growth rate in 2022 was only 3%. That means even the small growth looks larger, and we have to see what does it mean for 2024. If I follow the press, and consensus outlook for 24 is around 4.5, something like that. Let's see whether our speaker approves this idea as well. Of course, the issue is demand, the issue is geopolitical fragmentation, the real estate sector, and all the things we already know. We had an important conference in December, the Central Economic Working Conference, as you perhaps also know, and there was some signal for fiscal policy and monetary policy and fiscal stimulus. Whether this will happen, already something happened, and to which degree is another story. And it had also to help. This is a little bit, so we have a lot of uncertainty, and this is, of course, a very critical and important year for the Chinese economy for the further development. Yeah, having said that, let me now introduce our speaker. We will start with Dr. Xiong. He's the chief economist of China, Deutsche Bank. Welcome to you. He's in Hong Kong. We had you already a year before, if I remember right. He's already 6 years there with Deutsche Bank as chief economist. He was before with the International Monetary Fund for some years, and he has a master and a PhD from the well-known Peking University. Our second speaker is from Germany, Mr. Volkmar Baur. He's the China economist as Union Invest, the mutual fund of the Z Bank, and he's there still 3 to 4 years already in this position. And actually he was, I saw that also with Deutsche Bank as a senior investment strategist for 9 years, and he has a degree as an economist from the Stockholm School of Economics. So also welcome, Mr. Baur. Welcome to you. You are all familiar with the procedure. I have to excuse my colleague, Professor von Rosen. He can't make it today, so I will moderate this alone. The procedure is clear. We have now the 2 introduction statements, starting with Dr. E. This will take 10 to 15 minutes each, so we have 25 minutes or so then for the Q&A session. We will record the introduction statement, but we will not record the Q&A, so feel free, of course, for your question. Having said that, I hand over to Mr. E. Again, thank you very much. So the floor is yours. Please go ahead.
Thank you. Thanks again for having me again, coming back to this discussion of economy. I recall we had a discussion a year ago when we do have the view on that China's economy reopening. We will see the economy rebound. I think that indeed happened. The growth rate of above 5%, achieving the growth target, has been achieved last year. But obviously, the financial market hasn't been doing very well. And from some people's perspective, the economy is perhaps not meeting people's expectation. So how do we think about the economy for this year? I think first, look back on the economy, where the economy it is right now. From my perspective, I think one thing is almost sure, that is China's economy is, despite the recovery, still operating at below potential growth. And that is not just from the fact that the growth rate has dropped to around 4% on average in the past 2 years, or 4.5% on average in the past 4 years, compared to more than 6% growth in 2019 and before. So there has been a sharp drop of growth rate. But there's also obvious signs of that the economy is not achieving potential growth. The capacity utilization rate has been lower this year compared to before. And also the inflation rate, both consumer price inflation and the producer price inflation are at very low levels. PPI is at negative territory, and CPI is also for half of last year below zero. So I think all those signs point to the fact that the economy is not realizing its full potential. And the problem is not a supply issue, but it's a demand issue, that the overall demand is not sufficient for China's growth to be up to its potential. Now, why there's insufficient demand? And we can do a very simple breakdown, as we economists do, of demand by consumption, investment, and net exports, which is external demand. So if we break down China's growth last year, I think the conclusion, at least I have, is in consumption is probably not the reason that growth disappointed people's expectation, because consumption is contributing to more than 4% of the 5% growth we're seeing last year. I think the reason of insufficient demand comes from both investment and exports. On the export side, I think it's important to recognize that exports is contributing to negative 0.6% to last year's growth. And even if we were to do a historical comparison, that is probably one of the bigger negative contribution years over China's past 2 decades. We also have global trade shrinking. I think last year, and China's exports growth was also negative. So it's something that to keep in mind. Exports was a big drag, although we don't seem to talk a lot about that over the past few months. It has been rebounding, though. I guess the export growth has already turned positive in December. Exports is one thing. Also on investment, in the past, when we see that China's exports contribution to growth is a big negative number, normally the investment contribution to growth would increase to offset that impact from weaker external demand. But I think last year, at the aggregate level, we see investment still contributing to 1.5% to growth, the same as 2022, and lower than, I guess, the years before. So investment, we haven't seen that offsetting impact. Increase in investment has not happened last year. So I think that's basically a brief assessment of why there's insufficient demand. Now, if we take a deeper look at why investment hasn't rebounded, I don't think it's a lack of policy response. The government did increase its policy support, especially in the second half of the year. But I think on the one hand, the government has been boosting growth, investment growth in the infrastructure and in the manufacturing sector. But on the other hand, we do have China entering in the 3rd year of a prolonged property sector downturn. So property investment has been dropping for 3 consecutive years. Property investment used to account for about 15% of GDP. In 2023, that number has dropped to around 9%, above 9%. So almost 2% of GDP drop every year for over 3 years' time. That's the reality is that China's property sector is really in a kind of a longer adjustment than what we have seen in the past, and that is having big drag on growth, especially from the investment front. With the lack of demand, the inflation is also becoming a problem. It is caused by insufficient demand, but once inflation starts to drop, it also has a negative impact on the economy. Because if we think about companies, their revenue, their profits pretty much depends on not just production, but also prices. So if inflation is low, then that means companies' profit margin will be reduced and they will not have the willingness to invest more than before. Also for consumers, if you're seeing that prices on the market are stable or falling, that makes consumption decision, I guess. So to some extent, it makes consumption not that attractive because you know that prices might even fall going forward. And also If you're keeping money in your bank accounts, that value in real terms, the purchasing power will increase. So that also have some negative impact on consumption. So I guess that's the assessment. The economy is operating below potential, but because of all these issues, weak external demand, property sector, and also the low prices, it doesn't have sufficient endogenous momentum for the economy itself to have a strong rebound, to return to a kind of more equilibrium level. So what to do here? From here, I think the quick answer to that is that this is exactly the situation where government policy will play a bigger role. And that is where I think things actually would have a brighter outlook this year compared to 2023. If we were to think about the government's policy, the turning point of China's policy stance was in the middle of last year, in July, after the Chinese Politburo meeting. And since then, we have seen measures on the monetary front. There has been rate cuts. We have seen measures on the property sector. There has been loosened restrictions, lowering borrowing cost, and also, I think, lowering down payment, and also I think removing many of the purchase restrictions in cities for home buyers. More recently, in the past 2 months or so, we have been seeing more announcements from the fiscal policy. And I just want to list, I think, the critical major announcements we have been heard since late October. First, there is a 1 trillion renminbi stimulus into the infrastructure. The funding has already been secured by issuing 1 trillion bonds, and most of those projects will likely be executed this year, and many of them probably has already started, or if not, maybe it will start after Chinese New Year. Secondly, we see that the government is providing a lot more support into the property sector through public investment projects in social housing, in urban redevelopment, and in some other public facilities. So I think this part is where the government's approach has changed to some extent, because last year a lot has been done to stimulate the demand from the property demand from the private sector, but because we have been in a downturn for almost 3 years and property prices is not rebounding, it's a bit difficult to really convince the home buyers that this is the good time to come out to buy. Maybe the policy is not as effective as in previous cycles. But I think what the government has been doing or starting to do this year is by basically investing in public housing. Those demand will happen. Those investment will provide them, I guess, a boost to property sector investment. Recognizing all the headwinds that we still have to the property sector, I think at least we can expect property sector to stabilize, to become less of a drag on growth into this year. But on top of that, I think the infrastructure investment we're talking about, this 1 trillion already issued. The market is talking about there could potentially be more, maybe another 1 trillion RMB of investment in infrastructure financed by longer term government bonds. And these investment projects will again add to the issue to China's demand, and will help to narrow the gap between supply and demand. In the past, we have seen that whenever there's a larger fiscal stimulus and there's a boosting investment demand, then the prices normally would reflect that and start to increase. So the investment, public investment especially, has quite good correlation with China's prices. So I think recognizing that the government is doing a lot more on the fiscal front, I think we should also probably taking a more positive view on China's inflation developments. My own view is that inflation will not stay in negative territory. We should see them rebounding to positive territory by middle of this year, and for the full year, maybe inflation will be average around 1% for both consumer inflation and producer price inflation, compared to both negative readings last year. So what does that bring us to growth? My forecast of China's growth for this year is at 4.7%. I think it's more or less in line with what most people on the financial market is expecting. But I think we do recognize that there could be some upside risk to this growth, because one crucial variable from the government is what will be the growth target for 2024. My expectation is that the government will set the growth target at 4.5% or above. That's my expectation. I still think that's probably what's going to happen. But just in the past few days, we are seeing the Chinese provincial governments announcing their growth target, and it's quite interesting to see that three major places, Beijing, Shanghai, and Guangdong, these are basically the center of China's three main economic zones. All three local governments has decided to set their growth target for this year at 5%. In the past, the growth target outcome from these three places is actually quite a good indicator of where the annual growth target could be. So I think that does point to the potential that maybe we will be looking at a 5% growth target for this year after all, rather than 4.5%. And if that indeed is the growth target we get within, I guess, 1.5 month time by early March at the MPC, that could be a positive surprise to the economy and also to the financial market, because the Chinese government has a very good track record of delivering on the growth target. And in the past, it would be very, very rare for the government to miss on the growth target unless there's extreme circumstances. So for this year, I'm sure whatever the growth target the government set, it probably will deliver that with all the policy that is needed. And then on the price front, last year we have a GDP deflator of -1. So that means although we had 5% real GDP growth, the nominal GDP growth is only around 4%. And that nominal GDP growth in 2023 is even lower than its growth in 2022, as we have discussed earlier, that lower nominal GDP growth is not a good thing for companies, especially for their profit margin and for the decision to invest. And that in part explains, I guess, why Chinese financial assets, especially equity market, hasn't been doing very well last year. But if we do get a 4.7% growth this year with some upside, and if we do get inflation general reaching 1%, then that would mean China's nominal GDP growth will be around 5.5 to 6%, rather than the 4% growth we're seeing last year. There will be acceleration of China's nominal GDP growth. I think that is really what is necessary to bring back better sentiment, to bring back the animal spirit among companies, so that they will be willing to invest more, because we'll be seeing prices increasing and their revenue and profit margin improving from last year. So with all that in mind, I would say that recognizing all the challenges, I am taking a more positive outlook on China's economy for this year.
Ja, können wir wieder draufnehmen? Ja, great. Thank you very much. I understood you're actually really a positive outlook. Happy to hear that. We will see how the audience react, and I'm also very much interested now on the statement of Volkmar Baur. Let's see how optimistic he is, or maybe not so much. Let's see. Okay, Volkmar, the floor is yours. Please go ahead. You are muted. You are mute.
Yeah.
Yeah.
Yeah. Now
it's fine. Okay.
I will also try to share some slides. Let me just get that. You should be seeing the slides, right?
Yes, that's right.
Okay, so that's to begin with. Thanks, E, for the very good introduction. You made some good points. I think in the end we're landing on similar numbers with the forecast. I think I have a different way to getting there, and we might have some disagreements, which probably is a good thing for the audience. Some different opinions. This is my attempt at a word joke in Chinese. China's long year. Some of you know long is obviously dragon. 2014 is the year of the dragon. So like I said, that's my attempt at a word game in a language that I'm still trying to learn. But let's see how we get here. So I think it's important to see if we want to look ahead, where are we coming from? And if we will take a step back and look at the GDP numbers over the last 20 years, we see that continuous step down, which maybe has accelerated post-pandemic or over the, let's say, 4 years of COVID that we had last year. So I think it's nice, or it's useful to think of these last 4 years in a combination, because there is some lockdowns and rebound years. 2020 has been a lockdown year, 21 rebound, 2022 much of a lockdown year, and now 2023 is again a rebound year. So that makes looking at year-over-year numbers difficult, and we don't have very good month-over-month seasonally adjusted or quarter-over-quarter seasonally adjusted numbers in China. So we're always stuck looking at year-over-year numbers, but obviously the reopening, lockdown and reopening cycles make that difficult. So it's useful, I think, to take a step back, looking at it over a longer period, and what we're looking at, we're seeing that we have that continuous step down in growth, which is probably then, in that longer context, not that much surprising. Over the last 2 years, like was mentioned before, we had 3% in 22, 5.2 in 2023. That makes for growth of 4.1%. Over the last 4 years, it's been 4.7, and I think that is roughly around the territory where what our expectations should be for 2024. Looking at some components of GDP, the industrial production and retail sales, we see a very similar number. There's a lot of volatility in year-over-year numbers, given this lockdown reopening cycles. But if we look at annualized numbers compared to 2029, we see a pretty clear downward trend in industrial production as well as retail sales. So this is probably like our starting point where we should look at. Also, if we look at last year, I think, or over the last few years, we've seen structural problems come to the fore, and this is obviously problems that are not going to go away. We've seen population growth dip significantly negative, minus 2 million people in 2023. And of course, this is not just a number on paper, or 2 million people, but with that comes a smaller labor force. There was probably less rebound in employment than we would have hoped for in 2023, which then gives concerns for 2024. And the urbanization has also slowed down significantly. Lots of people who went back to the countryside are not coming back to the cities, and are therefore not as productive anymore. And the other thing, I think one of the big differences I have with E is that I don't think China is the Chinese economy is working under potential. I think the Chinese economy is quite a bit above their potential in the political economic setup that they are having. And I think the way to look at it is not like in a Western economy with capacity utilization rates and inflation rates, because in the European or American sense, or how the economy is run, the supply side is always the constraint, and the demand side causes the inflation and runs up against the constraints. In China, it's upside down, because everything is concerned with the supply side and improving the supply side, and actually the demand side is the constraint. So given the political setup that all the stimulus is always going towards the supply side, we actually probably, it's better way, or I think it's the better way to look at credit over nominal GDP growth. And what we see here is that we have a significant step up in the ratio of new credit growth to nominal GDP growth over the last few years. So we need a lot more credit to reach the same amount of nominal GDP growth. And this is a concern. So we actually would need a consolidation here, 2016 to 2019 were some good years where there was a significant depression in compression in that ratio, and now it has widened out again. So I think rather than below potential, actually the Chinese economy is running above potential in the political setup that we're having, in the political economy setup, that everything is supply side driven. So where are we going from here for 2024? I think it's nice to break the GDP numbers down in the components and the expenditure components, to look at them separately. We can get a clearer picture what the drivers are. For the private consumption, it's obviously retail sales and service consumption. You have the government consumption, which is not very volatile. We go over that very quickly. And then the most volatile part is the investment side. And this is also, I think, coming from my analysis, a difference that I have with E, that I think investment has actually been too high, continues to be too high, and has further to compress. And then, of course, we have the external side, which also China has been running too high of an trade surplus. And last year the contribution was negative, but it was only because of the reopening, and some service trade and tourism came back, and that's been dragging the external side down. But taking that away, we probably have a positive contribution again, but structurally that's still too high of a level. But let's go into the details. The service side definitely has still some room to recover. When we're looking at travel, domestic travel, it has been rebounding very strongly from 2023 or all through 2023 compared to last year, which probably isn't a surprise, but we still have some room to catch up to the trend growth rate from before when COVID hit. So there can still be some very nice growth, some catching up. We also see that in the catering part of the retail sales numbers, which is restaurant sales. They still have some room to catch up. But the binding constraint here is probably the money that consumers can spend, and all the disposable income on an economy-wide level. We can look at the number of employed people, the wage growth, and the savings rate, and that's the money they are spending. And when we look at that and we put some numbers in for 2024, we get around an 8% growth rate for retail sales in 2024. Which is probably a little bit above consensus in what I have. So this is going to be the growth driver. Even though it is constrained and we have seen a significant step down in the last few years, there's still some room to catch up. And I would expect that to be a good driver. But structurally, we're on a slower path, with disposable income growth having seen a significant step down in the last few years compared to before the pandemic. And the savings rate, which has been quite a little bit increasing over the pandemic years, is also back to trend. So we should probably see some de-savings, that it's dipping below trend for a little bit. But other than that, there's not much more room to give here. The government spending side, like I said, is not very volatile. We have a structural problem that the tax intake of the Chinese government in comparison to GDP is on a downtrend, has been for many years. We would need a structural reform here, we would need a tax reform, but this is not forthcoming. There's no signs that the government is working on that. So we probably see a sideways move here in the government consumption numbers. And then we come to the most interesting part, and that's the investment part. When we look at investment, we're mainly looking at manufacturing investment, infrastructure investment, and real estate investment. Combined, these three make up about 70% of investment in China. And what we've seen here is, like E said, we do have some low capacity utilization numbers, but the flip side of that is we have overinvestment causing these utilization numbers to drop. And there's not been a reaction really to these low capacity utilization numbers. You would expect that investments are going down, but actually investment has been going up because it's politically incentivized to invest, especially in the auto sector, with the e-mobility gaining more and more traction, but also in the electronics, where there's a lot of focus on semiconductors and catching up with the West in EI and semiconductors. So there's some politically incentivized overinvestments that are not that are depressing utilization rates. This is showing up in total factor productivity, depressing growth. So it's actually investment that is not quite productive. There might be it's always possible that the productivity will catch up and the investments are paying off, but for now it seems that it's not very useful investments. The infrastructure side, the problem is with the infrastructure side, not like many argue that there's nothing to invest anymore in China. I think there's still a lot of investments that can be done in infrastructure in China. The problem is who's going to pay for it. For years, land sales have been paying for infrastructure investments. In the last few years, bonds have increasingly taken over. But we're also coming at a level where the government maybe not be willing to ever more increase the special government bonds that local governments can give out and then invest in infrastructure. Land sales on a structural downtrend, they will continue to downtrend. So there's not much room to growth anymore for infrastructure investments. We have seen 2 years of quite significant growth, of about 10% in 2022, 6 to 7% in 2023. So this is going to be, we're going to have a hard time seeing these kind of growth numbers again. So this should also come down. And then the last one, we already talked about the real estate sector. Obviously, the real estate sector has been in a significant crisis. Housing starts are almost 50% down since the high point in 2021. Housing starts are more than 50% down. And all this is translating into investment. For me, the best way to look at it is looking at 3-year rolling starts from the housing sector, and that translates pretty good into investment. Why 3 years? Because it takes around 3 years to finish a construction site. As long as that is not finished, investment goes in. These 3-year rolling starts now is 2021, a very high numbers roll off. We're still going to see a trend down in the 3-year rolling starts. Investment's going to have a very hard time this year again, probably dropping again by around 20%, weighing overall on investments. So we see a problem on the investment side coming from these 3 very important sectors, which is probably going to depress investments in 2024 again. And then on the net export side, this is probably the positive story we have to tell here, even though it's obviously taking demand from the rest of the world. The service trade has been increasing. The net service trade has seen significant downflows in 2023. Based on the rebound, based on tourism, much of that has dragged on net growth or net exports contribution to growth in 2023. This will level out. So there's some tailwinds from that. And we see obviously that continuous improvements on the export side, that we see that China is able to catch more and more value added. It used to be that you're buying stuff, you're finishing some things, or you restructure some things and then you ship them off to exports. And that part where you do something internally is catching more and more value added. So the ratio between export value and volume to imports is roughly flat, but for the exports it's continuously going up, and that obviously then is a positive for net exports. So putting it all together, I'm looking at a growth expectation of 4.4% for this year. So I'm a little bit below the number that Xiong has. I'm also more concerned on the inflation side. I also see them coming back to positive numbers also around mid-year, but overall it's probably going to be a year all in all of around 0 inflation. So at least we're coming from a negative deflator to a slightly positive one again, which then in nominal terms, actually China is going to grow a little bit faster than last year. We're looking at 4.5% compared to 4% in 2023. And as the world lives in nominal terms, in nominal dollars, this is going to be a slight positive for global growth, as it gives a little bit more growth into the world. that would be it from my side.